You want to start investing, but do not know where to begin. Thousands of investing apps exist, and most of them look confusing. One wrong account choice could cost you thousands in future taxes. Most beginners freeze the moment they open their very first app. One exact account type protects your money from unnecessary taxes forever. One simple portfolio strategy beats almost every complicated trading method out there. Most people never even learn the right moment to sell a stock. Holding on to the wrong stock for the wrong reason can drain your savings. By the end of this video, you will know the entire process. Every single step is simple enough for a complete beginner to follow. Today, you are going to learn how to start investing from zero. Maybe you already feel overwhelmed by apps, fees, and confusing investment terms. This video breaks down the exact system smart beginners use to grow wealth. You will learn which account protects your money and which one wastes it. You will learn the simple three-fund portfolio that professional investors trust. You will learn exactly how to place your very first stock order. You will learn the 3 real reasons to sell and when to hold. None of this requires special knowledge, a huge salary, or investing experience. It only requires the right information delivered in the right order. Let's start with the very first decision every investor has to make. Choosing an investing platform feels overwhelming with so many options available today. First, check that the platform protects your cash if the company fails. In America, that protection usually comes from SIPC or FDIC coverage. Next, look closely at the fees because small charges add up fast. A platform should offer real account types, including a Roth IRA option. It should also offer a wide range of stocks, funds, and ETFs. Finally, the platform needs to be simple enough for a total beginner. A confusing app makes investing feel harder than it actually needs to be. Plenty of platforms meet this exact checklist. So compare a few first. Once you find one that fits every box, you are ready to begin. Before opening an account, gather a few important documents in advance. First, you need a valid photo ID, like a license or passport. Second, you need your social security number for identity verification purposes. You can find this number on old pay stubs or tax forms. Third, you need proof of address, such as a recent utility bill. Fourth, most platforms ask for a quick selfie during final verification. Make sure you are somewhere with good lighting for that selfie step. These questions might feel personal, but every regulated platform requires them. Honestly, you should worry more if a platform never asks for these. Once your documents are ready, the sign-up process only takes a few minutes. Most platforms show you 3 different account types the moment you sign up. The first is a general investing account for buying and selling shares. You can open several of these across different platforms, just like bank accounts, but profits inside a general account get taxed as capital gains. The second option is a day trading account for short-term trades. Most day traders actually lose money, so beginners should stay far away. The third and smartest option is a tax-advantaged retirement account. This account type lets your investments grow without the profits being taxed. Because it is so powerful, this account usually comes with a yearly limit. Understanding these 3 accounts is the foundation everything else is built on. A Roth IRA is one of the most powerful tools for a beginner. You invest money that has already been taxed one single time. After that, every dollar of growth inside the account stays completely tax-free. That means your stocks and funds can grow without any IRS cut. Over decades, this tax-free growth can add up to a massive advantage. A portfolio worth hundreds of thousands of dollars could owe 0 taxes later. This is very different from a regular taxable investing account. In a taxable account, the government takes a percentage of every profit. That single difference can be worth tens of thousands of dollars over time. If you do not already have one of these accounts open it first. A lot of beginners misunderstand how Roth IRA contribution limits actually work. Some people think the limit caps how much money you can ever earn. That is completely false. The limit only applies to yearly contributions. Others think the account can never hold more than a few $1,000. That is also false, because growth inside the account account has no real ceiling. You could contribute the yearly limit and still grow a huge portfolio. The limit only controls how much new money you add each year. It never controls how large your account is allowed to become. Understanding this myth alone stops beginners from underusing this powerful account. Once this clicks, you will see why experts push this account so hard. A savings account feels safe because your money never drops in value, but savings accounts usually pay far less interest than the stock market returns. Over the last decade, a simple index fund has beaten most savings rates. Of course, investments can rise and fall, while cash just sits still. Still, history shows the stock market wins over long stretches of time. A savings account works well for short-term, emergency money you need soon, but for long-term goals, investing usually builds far more real wealth. Keeping too much money in cash can quietly cost you growth every year. The right move is often a mix of both savings and investing. Once your emergency fund is set, focus your extra money on investing. A 3-fund portfolio is one of the simplest investing strategies available. It is designed to grow steadily and survive market crashes without stress. This method comes from a community inspired by the founder of Vanguard. It works because it keeps fees low and spreads your risk widely. The first fund is a total US stock market index fund. This single fund gives you a small piece of thousands of American companies. The second fund is an international stock index fund outside the US. This fund adds companies from Europe, Asia, and other global markets. The third fund is a bond fund that adds stability to your portfolio. Together, these 3 funds create one balanced, low-effort investing system. How you split your money between the funds depends on your risk tolerance. An older investor protecting their wealth might lean heavily toward bonds. A middle-aged investor usually balances growth with a bit more safety. A young investor, with decades ahead, can take on much more risk. Younger investors often skip bonds completely and focus on stock growth. That is because time allows you to recover from any market crash. Historically, the market always recovered and rewarded investors who stayed patient. If you sell during a crash for an emergency, you lock in losses. That is why taking calculated risk while you are young often pays off. Pick the split that matches your age timeline and comfort with risk. Seeing real numbers helps this strategy feel less abstract and more motivating. Investing $250 a month for 20 years adds up fast. That is only about $60,000 contributed from your own pocket. Yet, historical average returns could grow that into over $200,000. Increase that to $500 a month and the numbers grow further. That same plan could build a portfolio worth $500,000. Of course, returns are never guaranteed, and markets can rise or fall. Still, these numbers show the real power of consistent, long-term investing. Small, monthly amounts, compounded over decades, can create serious, life-changing wealth. This is exactly why starting early matters more than starting with a lot. Once your account is funded, you are ready to place your first order. A market order buys instantly at whatever price the stock is trading now. It is the simplest option and the one most beginners should choose. A limit order lets you set the highest price you will pay. The trade only happens if the stock drops to that exact price. A stop order triggers a purchase once a stock starts moving upward. A stop limit order combines both, giving you even more precise control. Long-term investors rarely need anything beyond a simple market order. Small price differences barely matter when you are investing for decades. Choosing the right order type is easier once you know these 4 options. Buying your first stock feels exciting and a little bit scary at once. Search for any company by name inside your investing platform's search bar. Open the stock page and press the Buy button to continue. You will see the current price along with several order type options. Fractional investing lets you buy a small piece of an expensive stock. That means you can invest $50 even if one share costs more. Review your order carefully before confirming the final purchase amount. Once confirmed, you officially become a part owner of that company. Individual stocks are riskier, so only invest a small portion of your money. Most of your money should still go toward diversified funds instead. Building your 3-fund portfolio only takes a few simple steps. Search for a total US stock market index index fund and add it first. Next, search for an international index fund and add it as well. Finally, search for a bond index fund and add that too. Now, adjust the percentage split based on your age and risk comfort. A young, moderate investor might choose 50% US stocks, for example. They might add 40% international stocks and 10% bonds. Many platforms even show a projection of future growth based on history. This projection can be motivating, even though real returns are never guaranteed. Once your split is set, you can automate future contributions every single month. Most investors obsess over buying, but forget that selling matters just as much. Stock prices move based on three different types of underlying value. Fundamental value is what a company is actually worth based on real numbers. Trading value reflects short-term supply-demand and daily price patterns. Momentum value is driven purely by hype trends and raw emotion. When a stock runs on hype alone, its price becomes extremely fragile. Once that hype fades, the price usually collapses right along with it. Watch for sudden spikes in online attention with no real business reason. If you see this happening, consider selling a portion to lock in gains. Momentum always fades eventually, so never fall in love with a rising stock. Sometimes the best reason to sell has nothing to do with the stock. You might find a better opportunity that needs your investing capital instead. A real estate deal or a new business might need that same money. Holding a risky stock while waiting on a bigger purchase adds unnecessary risk. Many successful investors take profits and reinvest into things they can control. Waiting too long for a stock to recover can cost a real opportunity. Your money should always go toward its highest and best use available. If a stronger option appears, do not be afraid to redirect your capital. This kind of decision separates strategic investors from emotional ones. Always ask if your money is working as hard as it possibly could. Sometimes, outside forces completely change a company's future without any warning. Ask yourself if the company is losing ground to a stronger competitor. Ask if leadership has made reckless or dishonest decisions recently. Ask if the entire business model is becoming outdated because of new technology. If the answer is yes to any, it is time to exit. Stocks do not care how loyal you feel toward the company. Holding on purely out of loyalty can quietly cost you real money. Smart investors are willing to cut ties the moment fundamentals actually change. This mindset separates investors who adapt from those who get left behind. Selling for the right reason is just as important as buying for one. Let's quickly recap everything you just learned in this video together. First, choose a protected, low-fee platform with the right account types. Second, open a tax-advantaged account, like a Roth IRA, for growth. Third, build a simple 3-fund portfolio matched to your age and risk. Fourth, make your first investment using a straightforward market order. Fifth, know the 3 real reasons to sell and stay patient otherwise. None of these steps require a large salary or any special experience. They only require the right information applied in the right order. This is the exact system that turns a beginner into a real investor. Every single piece of this plan works together as one complete system. You do not need to do everything on this list today. You only need to take one small step to get real momentum going. Open an investing platform today and gather the documents you will need. That single action puts you ahead of most people who only plan. Momentum builds fast once you take that very first real step forward. Small, consistent actions compound the same way your investments eventually will. Do not wait for the perfect moment, because it will never arrive. The best time to invest was years ago. The second best is today. One small decision today can completely change your financial future. Take that first step right now before you close this video. The people who build real wealth are rarely the smartest in the room. They are simply the ones who stay consistent when everyone else gives up. They do not panic when the market drops and prices turn red. They do not chase hype or jump on every trending stock. They trust a simple system and give it enough time to work. Compounding does not care about your motivation, opinions, or emotions. It only responds to consistency applied over a long period of time. If you invest regularly, reinvest your gains, and stay patient, you win. That is the exact same strategy that has built fortunes for decades. Your future self is counting on the decision you make today.